Notes can come in a lot of different flavors. For me personally, I did use a capital investor to buy my first note. The main idea for typically when I work with sellers who are interested in selling their notes, they're looking to get cash. If you have rentals, if you have all those tax advantage properties, this could be a good way to kind of increase your monthly cash flow, especially if your monthly cash flow is like diminishing.
This could be appealing for people that have W-2s and they love the idea of real estate investing, and this niche can be appealing to those type of. Hello, welcome to another episode of the Agent to Investor podcast, where we talk about the agent side of real estate investing. We'll be talking about the successes, the failures, and all in between. My name is Nico Garcia, local real estate agent and investor based out of Montgomery County, Maryland. And as always, I'm joined by my co-host,
Anna Bialik, Northern Virginia realtor and mostly out-of-state investor.
And today we have another wonderful guest. We're going to be talking about a topic that honestly Anna and I don't know too much about, so we'll have a bunch of questions. Welcome Sierra Davis to the show. Thanks so much for coming on.
Yeah, thanks for having me. Really appreciate it.
Awesome. We got introduced through a mutual friend, and I heard you on another show talking about note investing, but I wanted to give you some space to, introduce you, where you're from, and then what actually got you introduced to real estate.
Yeah, absolutely. So I'm Sierra Davis. My company is called Essential Investment Group, and basically I help people build wealth by acquiring performing real estate notes so they can earn passive income from real estate without tenants, repairs, or landlord headaches. And so I've been doing this since 7 years. And so it's given me the ability to do really amazing things and explore the world and travel and pay out student loan debt. So it's kind of afforded me the ability to have this passive income without having much of the active to-dos of things that are in traditionally within real estate.
Okay, so what did you do before those 7 years?
Yeah, so actually I come from a background of tech. So I spent a number of years in the tech world as a data scientist. I'm in healthcare, as well as marketing, oil and gas. So I'm a big nerd. I graduated with my tech degree and then went to get my MBA in data science. So I was working my career corporate job for almost 10 years. I just quit in April. So this is a full-time newly. So I was doing that on the side for 7 years. Yeah.
Wow. Okay. And then I'm sure Nico has questions like,
Yeah.
what are notes? Because I
Yeah.
think I know, but I
Yeah.
don't want to pretend like I do.
Yeah, no, first of all, a very impressive background. And it sounded like you mentioned you're a nerd and you're looking into analytics. That could be a big asset when you're talking about real estate and things like that.
Yeah.
But what actually brought you to the real estate side? I know you were doing it kind of as a side gig before.
Yeah. So as I mentioned, so school isn't cheap. Student loans are a thing. And so I was looking for ways to supplement my income so I could pay down my student loan debt faster instead of 30, 50 years. So I had accumulated like over $60,000 worth of student loan debt through, 4 years of undergrad and 2 years of master's degree. And so I was trying to figure out, okay, what can I do? Everyone says real estate, right? So I started researching real estate and going down that path. And so I looked and, thought about things that I could do quickly that I didn't have to spend a lot of time to kind of analyze. And so I looked at rentals, I looked at fix and flips, I looked at wholesaling as well. But I got this book and I was like, it's called it was started thinking about mailbox money and how you can get these monthly payments from homeowners and become the bank. And so I was like, I'm intrigued by this. And so it was kind of like the minimal effort part of something that I could continue to work my, corporate job, work and do well at it while starting to think about the passive income. So all I wanted was $500 to replace my, to supplement so I could pay off my student loans faster. And note investing was that avenue that I did.
Yeah. I'm so glad you mentioned, when you're starting, there's so many different ways you can go. And, it's very common. Everybody gets kind of overwhelmed with short-term rentals and fix and flips and things like that. And I love that you kind of found one that kind of met with, what you were trying to do. Your mailbox money. We try not to use the P word passive because, in real estate, nothing's really, really passive. But I do want to talk about note investing. So, first of all, do you mind explaining what note investing is
Yeah.
and how somebody can get into that if they weren't?
Yeah. So I'm gonna say 100% sure everybody listening to this has been on one side of this, like mortgage note payments or anything. So if you own a home, if you bought rental property, if you invested in a while, you've probably been on the other side. So essentially, when you're getting a property, if you will, you may not purchase the property for full cash. So you get financing from the bank, and so the bank will then create a promissory note, as well as a security instrument, whether it's a mortgage, state, or a deed of trust. And essentially, you're basically saying, because you financed this property for me, I now owe you. And so the mortgage note and the promissory note is basically an IOU secured by property. And so when you essentially buy these notes that, a seller finance note, let's say a bank, or there's a bunch of different sources, you basically receive those monthly payments that was originally set up by either the bank or someone who's doing seller financing. Instead of, owning the property, those basically notes or those payments are assigned to you. And so that's kind of how that works. And so you think about Chase, I tell people, like, Chase doesn't care what color your cabinets are. Chase is not going to fix your toilet if you call them. All they care about is you agree to set payment terms and monthly payments. You sign those contracts at closing, usually maybe for 15, 30 years, 5 years if you're doing multifamily. And basically those are those agreements. If you don't agree with those, there's things that can happen, whether they be a foreclosure, a deed of lieu, or something that allows the bank to recoup their investment that they made in you.
I know Anna asked this question off camera before we started recording, and it sounds like we both of us own real estate. Anna and I, we own, and we do have to deal with tenants and evictions and things like that. Is that what was appealing for you, Sierra, as going into this route, is kind of not having to deal with those kind of things?
100%, yes, because I knew my strengths, and I think that's where, like, oh, I don't have to get maintenance requests. I don't have to manage the property and the tenant. And so what really kind of stuck out to me was being able to be more hands off, especially when you're buying performing notes, the notes that are performing well, they've been paying. It might be a little bit more active if you're buying non-performing in that space. Those are payments that haven't been paid in like 90 days, and so you kind of have to work out with the borrower and foreclosure processes. So you are doing a little bit of that work. But really, the idea was, I was going to school, trying to figure it out, about to get married, all of that. So I was like, what can I do that doesn't stress me out? And I think this was the reason why I choose that. Yep.
Okay. So essentially, instead of buying the property, you're buying the loan from somewhere. I know banks package up and sell off their loans. And so you're buying the loan instead of the property. And then if something were to happen, then you end up owning a property that you may or may not have wanted.
Yeah.
I'm curious, with like flipping and all the other things, you need a capital investment. There's usually money required, obviously, to get started. With what you did you need a large capital investment to start buying these notes? Like, what did that look like?
Yes, that's a really good question. So notes can come in a lot of different flavors. For me personally, I did use a capital investor to buy my first note. So it was in, like, I would say, in the no more than 25,000 was my first note. And so I was able to get a capital investor, and basically we did like a split. So if I would, say I was getting $500 for the principal and interest payments, they would get 250, I would get 250. And then I, continued on and paid them off, kind of like matching whatever the payments were remaining in the balance. And so, yes, there is a capital required, but in the note space, you can buy partials of notes. You don't have to buy the full amount. And so, like, let's say if you interested in a note that might be worth 100,000, let's say maybe you can buy 3 years worth of those payments. And so, offering that to a seller. So the main idea for, typically when I work with sellers who are interested in selling their notes, they're looking to get cash. So instead of waiting 20 years for a note to complete. Maybe they need some cash now to do other deals. Maybe they like buying and doing seller finance. Maybe something's happened. Maybe they have some type of expense. But really, it's just trying to think through that. And so offering that ability to give them an opportunity to get cash now. So there's a bunch of ways.
That was actually going to be my next question. So who are the type of people that you're actually having these conversations with? It's actual sellers that are selling their homes on seller finances. They might be a year or two in, or are there other avenues you can go?
Yeah, absolutely. So typically, the folks that looking at are those who do sell properties on seller financing. And so they can do a number of ways. They can start getting payments, and maybe they've gotten 4 to 5 payments and they're ready to cash out and do another deal. And so those are the opportunities to buy these seller finance notes that are, newly originated. The borrower has been paying on them. So that gives a clarity of that. And then also there's some marketplaces out there that you can buy notes as well, that people will be interested in selling. But the idea is that the seller doesn't want to, the present value, the money today is worth, the money today worth now than it would be along with like the time value of money is a little bit different. So when you're thinking through that, can I get, my $50,000 now, or do I have to wait years to get it? So really and these people are everywhere in your different local RIAs, investor groups on Facebook, especially in the creative finance world. We have a lot of those people who are selling notes. We always think about the people who are trying to buy property through seller finance, but those people that took those payments and wanted to carry that back, those are people that might want to sell their notes.
Yeah, that was actually going to be my next question, because it sounds like there's a lot of word of mouth and you're part of a few creative communities. But are you actually where do you find these people that have seller finance notes that are even open to doing something like that?
I don't even know it exists, because I don't know that they know it even exists unless they're in a community.
Right. So that's the key for marketing. And so I have a website that people can go. So you can interested in selling your note. Did you seller, carry your note? And so that will kind of lead them to, there's, within the property records, you can see those notes that have been seller financed too. So you can market to them and say, hey, are you interested in selling your note? So those who are not, knowing that they can actually sell their note or assign it to someone, those are people that might need to be contacted outside of a traditional meetup.
Okay. And then one follow-up question. This may be a silly question, but is it strictly people that are selling their property on seller financing? Is there other ways that you can buy notes, or is it strictly on that?
Yeah, so the banks will sell notes. Typically they'll do distress, but say I've bought notes that were originated through the big banks, where an investor has bought and then they, continued on. So it's kind of like a chain. If you're looking at title reports, you see different chains of assignments. So those are kind of thinking through where the source is, but it's still mainly from an investor perspective from my end. Because I buy performing, so I'm not necessarily going to the bank and asking, hey, do you have any notes for sale? Because they probably will be distressed.
Okay.
Yeah.
I don't know if Anna, I had a follow-up question regarding underwriting, right?
Yeah.
So what?
I'm going to say I have one too that's similar, but go ahead, you go first.
So what makes a good note deal? You're actually making sure that they're paying on time, but is there anything else that you look for?
Yeah. So in the note investing world is keep it simple, the 3 Ps: property, paperwork, and the payer. So look at the property. Even though we're not buying the property, we're thinking about the value. So specifically, one of the main metrics is loan to value. And so is the loan, if they, the property's worth 100,000, and the balance is 70,000, the loan to value would be 70%. So thinking about if I did have to go through a foreclosure, can I sell this property for more than what I invested? So having that cushion and the equity is really key. Also, where the property is, even though, they have a strong return, but do people live there? Is the population growing? So similar to like, investing in like real estate, that property part is really key. Days on market is another metric. Like, if I did have to sell this property, how long will it take for me to sell this property? And also like where the property is located too. There's a differences between like judicial states and non-judicial states and foreclosure timeline. So if the property is in California, I might not want to be there. Or in New York, I might not want to go, So those are things that kind of thinking through the underwriting process of the property. Is it livable? You can do like a broker's price opinion and to have boots on the ground, especially if you invest outside of your area. So I do that. So I've been, I've used a BPO where places I probably won't ever go to, states that I probably don't want to, but, and so that's where the property has to be really strong. And I invest in land, mobile home, and single family. So that kind of applies to that as well. So looking at the values of that. And then the second is the payer. And so thinking through the payer, are they able to pay this loan? Are they qualified? So in our world, we use like a RMLO. Do they have bank statements to say that they can pay? Do they have income? Are they in bankruptcy? Have they been paying on time? Do they have a bunch of late fees attached to their payment history? And so those are questions that you can start to ask and really think through that. And then finally, the paperwork is really important. If the paperwork is not good, you can't foreclose on it. And so like that paperwork has to be strong. So what, you're looking for is all of these, is the promissory note there? If the promissory note isn't there, is the chain assignment broken? That then you have to kind of remedy those. Did you get the right paperwork for your underwriting for the borrower, especially if it's owner occupied? If it's investor owned, it might be a little bit different, but if it is, do you have a business use case affidavit that says you're not going to come and, live in this house yourself? So, excuse me, those are things that we look at. If the 3Ps is the high level important. So thinking through those are kind of like the biggest parts of the underwriting process.
Okay. My brain is like going, I don't understand it. This is new to me. So all the things of like how it could go wrong as an agent, I'm thinking, like you said, I'm thinking the chain of title. Is there like an insurance? Like when you buy a property, there's title insurance that protects you in case there's a break. Is there similar insurance?
They have title insurance or lender's insurance. Yeah. So you have like the title policy and lender's policy as well. Yeah.
Okay. And then you're always in first position. Like when you buy the note, I assume there has to be some paperwork that changes the name on all of that paperwork, but everything stays the same. Essentially, you're saying everything else stays the same except for the name, right?
Yep. So in closing, you'll do an assignment. And so the previous, lien holder will assign that to you. And so that then that basically says that these payments are directly to this this entity now. So that assignment basically gives you the rights to collect on that. I personally do first position notes. There's second positions. There's even third positions, but first position, I want to be the first in line to get paid. So those are the key points as well. So those are recorded as well. So you can see the chain of assignment and all those things.
Okay. And if they're taxed, if they have tax liens, I assume that's different because I think death and taxes are the two things you can't avoid. So even if you're in first position, a tax lien takes precedence, right? So,
it depends on what state. Yep. So it depends on the state. And so knowing your different state laws. And so thinking through that, yes, those are things that you have to kind of think through as you're going to different states and having what's precedent, HOA lien, solar liens, all of those different types of liens. Yeah, that's a really good question.
I like how you broke it down and with the 3Ps, because that kind of simplifies something that's complicated and try and make it more simple. But regarding like the actual paperwork, so I know you're gonna, have the promissory note essentially. what would make it like appealing to you? Is it like looking at the duration of the promissory note? Is it looking at the interest rate? Like you as the investor, what would make it appealing?
Yeah. So what would make it appealing to me is like the return that I can get. So if I'm targeting like a 12% return every year, am I able to get that within this note? And so the appealing for me is that the yield is good. So if it's a 13% yield that I can get on this note, that's really good. And when I do say yield, I'm not necessarily talking about the interest rate that the borrower is paying. So like say if the interest rate is at 10%, and the face value of they owe 35,000. What I'll do is I'll use a financial calculator and offer the seller a number that will hit my return. So that will increase my return based off of the offer. So they still owe that 35, but I'm basically buying it at a discount. So that way that I'm covered, and then that spread increases my return. So that kind of makes it appealing. And also like the value of the property makes it really appealing. So if they owe 35 and the house is worth 200,000, that is really, really appealing. And a state that doesn't have a long foreclosure process like Texas, even better. So those are things that I'm looking at.
Yeah. And then speaking specifically about like duration, I know when you're buying a traditional mortgage, 30 years, 15 years
50.
are the, and now
50
the
now,
50,
50 now, yeah.
are the most common. I know seller financing is generally different, and
Yeah.
it's all kind of negotiable with the
Yep.
seller and buyer.
Yep.
What are you seeing mostly with the notes that you're buying it, with the duration?
Yeah, that's a really good question. So I'm seeing a difference of like, for land, they're going to be shorter payments. So like 72 months is probably a max that I'm seeing. So they want to pay off that land pretty quicker. So they probably have a higher principal interest payment, which is really attractive. Whereas those, 30-year mortgages might have a shorter, a lower principal interest payment. So those are what I'm seeing there. I'm also seeing in seller financing probably a little bit above par, for interest rates. So like a 9 to 13%, interest rate. So because they can do seller financing, you don't have to, the banks are probably at 7% right now, maybe. So they're a little bit higher because you are not doing as a stringent process as the bank would. You can get a little bit a higher advantage within the interest rate. And then like the down payments are similar to the bank. So anywhere between like a 10 to 15% down payment is still good. So we're definitely still seeing that. So it's almost like a sense of the property type that you kind of see the differences in the months. You're not seeing too many of the short-term loans on single family that you would see on land or even mobile homes.
Okay. I'm making this complicated because in my brain, I'm like, okay, well, if I was the investor getting seller finance, I would want to do like maybe a 10-year note with a balloon payment at the end, but amortized over 30 years. Like, do you look at those too? Do you find those like appealing because you're going to get a lump sum at the end? Do you even hold on to them that long?
Yeah. So those would be appealing to me. And not some investors would be, but the reason was I kind of like my strategy, and because it's more personal, but I kind of could share. I wanted to replace my income and as long as possible. So I wanted the longer note payments. So if I know that I'm going to be paid $500 for the next 15 years, that's attractive to me. So then I don't have to, and then once it's done, but if I think about the shorter one, I have to replace it. So if it's a 24-month loan, I'm going to have to replace it in.
You got to do the work of finding a new one.
Yep. Exactly.
Okay.
Yep.
All right. I'll let Nico ask the next one because I have another complicated question, but go ahead.
Speaking like specifically to I always get this wrong. The lendee is the person that's going to be paying, right? The lender and then lendee. So
the borrower. We just say
borrower, right? So I know you mentioned you have like software and things to kind of vet them, but when you're buying, are you just talking directly to the seller, or are you actually getting info from this buyer to kind of vet and make sure that they are who they say they are and that they're paying off?
Yeah, that's a really good question. So for me personally, I look at the if the note is serviced by a third party. And so if you have a servicer, they'll take notes, they'll track the payments, they'll track whatever, how many times they've called and what they talked about. It's very, very specific. And so that you can kind of understand where the borrower is at from those notes. So if I'm making an offer, I'm going to ask for those, notes. I'm going to ask for those payment history from the third party. If they are self-service, that might be a little different. And so you can do a borrower, interview, if you will, to kind of ask are you still on your job? You did this seller finance deal maybe 6 years ago. Is everything still the same? So you can ask that, those types of questions. But really, if a good note is third party serviced, you kind of understand where they are now if they're in bankruptcy, because your servicer will do most of that work for you.
Are you seeing more people on the third party servicing route, or is it actually more of you doing or
it's
is it 50?
It's a wild west. It's
Yeah.
I've seen it's a 50-50 for me. I'm cautious because I know that there's such an uptick in seller financing now that it's kind of scary that people don't know that they should be, using a third party just to make sure that it's compliant and depend on the state. Sometimes you can't even collect on debt. You have to have a debt license. So those are really scary. So I'm hoping that people can get educated on creating notes well and managing them well with people and, companies that are compliant in 50 states to, be lending and things like that. So yeah, spreadsheets, I've seen it. Zelle, I've seen it, and
Yeah.
Cash App, I've seen it. Yeah.
Okay. And the only reason why I asked that is I'm putting myself in the borrower's shoes, right? And somebody comes out of nowhere, but maybe the seller's in communications with them and letting them know that they're thinking about this. But how do they initially set up? All right, I'm transferring all my payments instead of to the seller to you. How that conversation goes.
So there is a RESPA hello and goodbye letter. So that goes out by the servicer. So they're not, one day just kind of, they have to send this out immediately after we sign and close. And that says, hello, we're your new servicer, and say goodbye to this, and basically outlining that if you pay within a certain amount, you're not late or anything like that. So those letters will be sent to the borrower and they get set up. What I like to do to kind of ease that, if let's say I'm buying a note, if they're using a servicer, I will maybe just use the same servicer so they don't have a total disruption. So unless they just don't like the servicer. So I will use the servicer that they're already using, I'm comfortable with. They just have in a different account that they pay, and then the servicer can handle that pretty well.
Okay, because anybody who's ever bought a home, I bought one in November, and it's the mortgage is sold within a couple of weeks, right? So you get that. I always get, we're both agents, and I get the call hey, I just got this.
Is this real?
Where's my mortgage? And I'm sure lenders always get that. So this is kind of similar. If you're buying it, the communication is very important.
Absolutely, yeah. So that's why I said, I think we've all been in that place, my home, as soon as it, okay. I think it's been sold 4 times. So it's just once you change those servicers, those are kind of hints that they've been sold. Yeah.
A couple of times. Okay. I'm not going to go down the rabbit hole I was going to go down because I was going to get complicated. So I'll bring it up a level. So you were saying it's important to know your state laws and regulations. So for someone that's looking to get into this or newer, how would you recommend, what's the most efficient, effective way to get familiar? Because I assume, do you target a specific market and just get to know all of them, or how do you do that? How do you learn all that stuff?
Yeah, that's really good. So I think the part of educating, finding really good education programs that can kind of work with you to kind of understand what that looks like as you're starting to create your buy box. So there's people in this industry that have programs and things like that can kind of walk you through that. So really, this is kind of it's a huge learning curve, right? So there's no doubt about it. There's nothing quick about this at all. And so learning about it kind of helps. And, if you're starting out, don't buy notes in California, maybe stick to Texas. So I like to pick on California, but it's important to kind of think through those laws. And there's, public information out there to kind of like say the timelines of foreclosure. So like they do the charts. I think, oh gosh, the realtors will do some type of chart to say, here's the states and their foreclosure processes. So some of those are public information. And you also have to kind of know your risk, right? So your risk tolerance. Some people might like, non-performing notes in Illinois because in Illinois, the foreclosure process is pretty long. And so thinking through that. So really getting the education you need, understanding your risk tolerance, and being able to kind of work with somebody that can help you build your buy box and based off of your specific tolerance.
Yeah. So you read a book about it, and then did you sign up for something, or did you just say, okay, I can do this, I'll figure it out, like balls to the wall?
Yeah. So originally, no. So it took me 7 months to just start doing something. So it took me 7 months of education. I had a mentor that helped me buy my first note. I actually bought it from him. And that kind of got the ball rolling. I took a couple years to I just had that one note because I was just like, okay. I was being super lax about it and didn't even think it was going to be a full-time business as it is now. But then I started to get education through other investors and really started to do that as I wanted to scale. And so now I'm continuing to work with those same people. We'll both do deals and look through those. So yeah, I didn't go too much, but I did kind of go a little bit by myself. And so my first note that I did buy stopped performing. So that's fun. So it was a super learning. It was very learning in the first.
Oh man, talk to us about that, Sierra, because I know that's probably a fear that a lot of people have.
Absolutely.
And I know you mentioned being in landlord-friendly states. I mean, and I think that's any real estate investing. Yeah. If you're owning real estate or notes, you want to do that. But what happens? Did you have to take over the property or?
Yes.
You did.
Yes.
Okay.
Yes. So, the note that I purchased was a low loan to value. So the property was probably worth $75,000. So, I got the property back. I got paid 3 times, which was good, after I bought it. So it wasn't like zero payment. And then after that, I don't, to this day, I have no idea what happened. So canceled the contract, did all the things that you're supposed to do with the county. I just resold it on seller financing, created a new note, and then went from there. So that's where the value is super important, because if I bought that note for $70,000 and it was worth $75,000, and then I had to pay lawyer fees, I had to pay lease fees, I would have been probably underwater.
Yeah. So was someone living there? Did you have to get them kicked out? I feel like there's more to the story.
No, it's so funny. It's so funny. They were gone. I have no idea where they went. The house was just empty? Empty.
Oh.
So I noticed that they were starting to renovate because the stove was in the middle of the kitchen. There was no cabinets. And so it's just oh, wait, what happened? In my head, as a newbie, I was like, I have to fix this property up. And that was coming in my head. And so, I talked to somebody, it's like, just put it on the market. I was like, huh. And so I put it on the market as is, and it went from there because I wasn't thinking that way. And so someone allowed me to kind of think through that because I was freaking out. I was like, how much money do I have to put in this?
Yeah.
Have you had any other ones where you've actually had to have people removed from the property?
No.
Okay. So it hasn't been that bad. It could have been.
It
worse.
hasn't been. It could have been worse. It hasn't been that bad. I have non-performers, but it doesn't have. It's not eviction type of notes because one of them is a land one, and that one there was nobody on there, so you didn't have to evict them.
Talk to us about I know you mentioned having a mentor that actually helped you sell your first note. We talk about that all the time, being in the community and normalizing the conversation. How has that helped you in your investing journey?
It's helped a lot. I would say that this is a industry where there's not going to be a lot of people that are my age, just to say that. So that's a really good thing because they've been in this for 30, 40 years. And so having a mentor that has seen all the different cycles in real estate too, and what has happened and the mortgage prices and all of that, I'm thinking is super important because they know the paperwork. And even too, like they know the people who created these bad loans and they're like, oh, that's so and so, because I even see them today as you're looking through the chain of title. So it's really important as they can point out things and make sure, hey, be careful with this. They've probably modified this note. They did, bad lending policies. They just took, $500 down and ran with it and didn't do things well. So they can help me look at things that I didn't see before and kind of educate me on some of the context too, especially looking at loans that were, originated before 2008 or, even between 2008 and before 2020. So those are kind of thinking through like what a mentor would help with.
Just having like the expertise and the extra pair of eyes, which helps, with security, it helps you sleep at night, right?
Yes, absolutely. Because, it is, it's not a foul proof industry. You're in first position. You have the right to foreclose, close, but you still got money involved. Like you still have time. Like, that's also good about underwriting and they can help you. Oh, I know this state takes XYZ time and I had to pay $5,000 to this lawyer. And so that you can start to estimate those costs in your underwriting.
Nice. I'd love to talk specifically about like the different type of assets that you can do because, notes are technically you can sell anything on a note, right? So I know you mentioned land. I know you mentioned like a single family home.
Yeah. So land, mobile homes, single family. And a new category I've seen recently is business notes. So that's a different ballpark, and like you can seller finance anything like you just mentioned. And so, now you, instead of getting an SBA loan, maybe you're getting a loan from someone who seller finances a business. Even commercial property, I'm seeing a little bit more of that too. In the multifamily space is really interesting too, especially those like 5 to 10 year mortgages are coming due. So some of those are actually more distressed and not performing. So you're definitely seeing a little bit more not performing in apartment buildings and especially in areas, Florida, Texas, some of those high expense areas. And so it's a kind of an interesting, like a pool of those. I've seen a lot of land notes recently because I think land flippers are really starting to think, oh, my buyer pool increases when I do seller financing. And those are, like I said, those are really attractive for short-term, high return. So really there's a mix, but, the business notes are very interesting and those multifamily non-performing notes are kind of, they're increasing. Yeah.
But they just like regular real estate, those sound like those require a lot more work on your part. Like if they're non-performing or whoever buys the note, I assume their goal is to work to increase the value then or make it a performing note somehow.
I mean, it kind of depends. Like so there could be 2 extra strategies. You can get it reperforming, which is good, or you can do a deed in lieu. And so let's say they owe, ballpark, like a million. Maybe you buy it at a steep discount for 500. Like you just got a valued, value property and you get a deed in lieu because maybe the owners might be going through bankruptcy, don't want a foreclosure. So there's a different exit strategies. So people might actually buy non-performing notes to get the property. And there's some people that, do borrow resolution to get that reperforming. So it's kind of like that is a value add. So then they can sell it for higher than what they purchased for because they probably got it for a steep discount.
All right. So for those that don't know what a deed in lieu is, because I'm sure some of our listeners don't, can you explain what that is?
Yeah, so basically, instead of going through the foreclosure process, the borrower will sign over the deed to the lender instead of doing a foreclosure. So they'll get the deed instead of doing a foreclosure process.
Okay, so that's where the buyers or the person is willingly like, okay, fine, I'll just give you the deed instead of going to court.
Exactly. Yep.
Does it hit their credit? Is there an incentive for them to do it?
Yep. It's an incentive to do that. Yeah. Okay. So it doesn't like mess up your credit. It doesn't go through the foreclosure process. So Yeah. That might be attractive to people that are just like out, they have no other option.
Yeah,
So,
and they hit a rough patch, and they know that if their credit gets hit, that's going to make it more difficult for them. So I guess that's a good nugget to keep in mind. It's like that's a negotiation strategy.
Yep. So, and I think for me, like how I was taught through like that, your first line of defense is work with the borrower. Ask where they are. How can I help? Can we change the terms of this loan? What can you afford? If they're like dismissive, if they just don't want to work with you, those are, times of like, okay, maybe I can start the foreclosure process.
Yeah.
So you work with the borrower first, but if they're, they're not, willing, I think those are kind of the thoughts you have to kind of convey to them.
Got it. You meet them where they are and find a solution that's mutually beneficial, assuming they want to play.
Assuming they want to play, yeah.
At the end of the day, we're all trying to help one another, right?
Exactly. Yeah.
You want to be a good person, and first of all, so
yeah.
Sierra, I'd love to go like, if you don't mind, to give like a real life example of what this would look like. So, like, if I'm selling my home as a seller finance, like, simplified numbers of what you, Sierra, could come and buy my note for, and things like that. Is there any, I don't know how to simplify this in terms of like a real life example, but
like you get a postcard and you call her because you're like, I want to know what this means. And what does that conversation sound like?
Yeah. So let me think about, I think I can have like a really off-the-fly example. So like, let's say you sell a property for $125,000. Let's just, or $120,000. You get a down payment for $25,000, and then your loan balance is $95,000. So you've done a 360 months, and so your monthly payments will be around $760. And so you've collected payments, and maybe you have 250 payments left. And so Sierra, you kind of like, I need to sell my note. I wanted to see if I can get some cash for this note that I seller financed a couple years ago. And so what I'll do is kind of think through where the property is, the value of the property. Let's say it went up in value. Maybe it's 120 still, but we can just say if it's still 120,000, I'm looking to see, okay, my cutoff for my loan to value is 70%. And so thinking through that, one is what can I get for that? And then two, like the yield, if I want, let's say 11% return. So I would then kind of look through that and calculate it. And so I know that I'm able to get at least lower than 70% loan to value. And if I wanted to do a 11% yield, I would then offer them, let's say $75,000 to purchase this note. Now, again, that they might owe a little bit above that. Let's say, I think I would say like 85. But so basically, 86,000. So then they would take the offer or not. And so that's kind of where I would offer that price.
Got it. So it's for sellers essentially looking to, I guess, liquidate that note and move to other investments, right?
Exactly. Yep.
It reminds me of those commercials you see on TV where they want to buy your annuity. Like if you got a cash reward over 30 years, they're like, I'll cash out and give you a payment now for a hamburger. Was it a hamburger? I'll pay you tomorrow. Tuesday for a hamburger day.
Yeah. And so like that's where, the offers are strong, and they might say yes or no, depending on that. But typically that's kind of where I'm at. I mean, I don't like to go lower than 10%. But, meeting them at 11% is good. And even if you don't sell, even if you don't buy notes, you can also refer people. So it's not kind of like wholesaling, but it's not like wholesaling. But like they essentially can get a referral fee for connecting buyers and sellers, and maybe get 1% of that. So if the seller is good with 75, maybe you're at, the middle person referring, you might say, okay, let's buy, it's 72 would be good. And they accept that, and you get the 1 to 2%, 1 to 3% at closing. So that's a nice way to kind of get some cash if you don't have a lot of cash, and to make some good, really strong connections.
Do you have to have any kind of license? So I'm thinking now, because you equated it to wholesaling, and I know with wholesaling, a lot of states have put restrictions in place to try to curb the wholesaling wild west. Is there restrictions or like what's required to do that?
Yeah, so different states have different licensing requirements. So I will let people know that they will need to check their local policies in there. So there's a couple of states that you have to have a license to uh, broker notes. So yeah, there's some. It's not as bad as wholesaling because I think wholesaling is a crazy wild west, and depending on where you are, so it's not like super regulated to get to because of something that happened incorrectly. But I think it's just more so how it was kind of structured before. So yeah, it's not mitigating the reversing some of the things that could happen within wholesaling.
So we talked in the beginning about like the type of people that it would be appealing to get into note investing. And I think I heard in an interview you talking about real estate agents and how, they could benefit from a strategy like this. You might talk about like how that would look and why it could be appealing to the agents. We have a lot of agents listening to our show.
Absolutely. I think agents are really good because you know your local market, you know the property values well, you know who's selling, you know who's buying. And so thinking through like that first level of the property, you have access to all the sales data, so you kind of can understand some of that value of the property. And two, like if you're interested in like the monthly income, I think this is a really good strategy. So you're not like looking straight at commission, but maybe thinking through like, could you use the commission to buy a note, buy partials of a note to kind of get that supplement of that income? Because I think you have an advantage as a real estate agent because you have a lot of data, you have a lot of resources, sellers and buyers, negotiation as well, especially that part too, as you're making these offers and you know why certain things like you drive by, like, oh, nope. So I think you're a little bit more stricter, especially in your local market, to kind of be a good, strong candidate to get into notes.
Well, because I'm thinking, so as an agent, a lot of times we advise other agents to buy real estate because there's tax advantages and it kind of brings down their tax liabilities. Are there tax advantages to having a note, like like when you buy an actual physical property?
No. So
that's the downside.
That is the downside. So there is no tax advantages. And so I think for me, like I say that this is a complement to what you're already doing. And so if you have rentals, if you have, all those tax advantage properties, this could be a good way to kind of increase your monthly cash flow, especially if your monthly cash flow is like diminishing based off of insurance and taxes and all of those things. So I think it's a supplement. There are, tax advantages, there's ordinary income, as simply as that. So I would say like if you kind of think through maybe your strategy or maybe your diversification of your portfolio, I think it's a good way to kind of add to your cash flow. Yeah.
Love it. Speaking of cash flow, so I know when you're underwriting a rental property, right, you got to put the maintenance and CapEx and things like that. Is there anything that you would factor in when you're, underwriting a note deal kind of similar?
Yeah. So typically I'll look through like my closing costs. I call them closing costs, but, to kind of keep it level, like my onboarding fees for the servicer, maybe like $125. So I'm thinking of like maybe 500 to 800 because you escrow and things like that and paperwork. And after that, it's $25 a month.
Budgeted away. Okay.
That's it. Per note.
That's why it's more passive, right? You're that's the whole goal. And this could be appealing for people that have W-2s and they love the idea of real estate investing, and this niche can be appealing to those type of people.
Yeah, exactly. Yeah.
Okay. And I see there's a note investing book right behind you.
Yeah.
Where would you recommend like people to, learn about this?
Yeah, absolutely. So I have a couple ways. So there is a free educational course that I have. It's wealthwithnotes.com. You can just sign up and get just education from start to finish of the seller finance notes. My book is available on Amazon if you look up Sierra Davis note investing. And there's a lot of different mentors out there. Noteinvestor.com is a really good process to go through because I think it was really educational for me. They kind of expand all types of different notes. So that is really recommended. I recommend it in my book as well. So they're really good people. But yeah, if you can get education and identify your risk, if you're into performing notes, that's kind of where this kind of book kind of teaches you that. If you're interested in other types of notes, maybe some other avenue, but really just kind of focusing through the learning, because it is a lot having someone be able to kind of guide you if you do need it. But I mean, I'm always able to help people, especially getting started and where direction they need to go.
What's the name of your book one more time, Sierra?
Yeah, so it's Rethinking Retirement with Note Investing by Sierra Davis. Yeah.
Awesome. And they can get that, where they buy books, Amazon, anywhere?
Yeah,
She said Amazon.
Okay.
Yes.
Cool. Well, this is a lot of fun. I'm
Yeah.
sure, and I have a ton more questions, but
Absolutely.
we'll have to bring you back on. But
Yeah.
if anybody had any more questions, where can they reach out to you?
Yeah, so you can reach out to me. I'm on social media, Sierra Davis Official on Instagram and YouTube. And can go to like wealthwithnotes.com and sign up, and I'll send email through there as well.
Awesome. Well, that's going to do it for another episode of the Agent to Investor podcast. Please like, share, subscribe, reach out to Sierra, and you can reach out to me at N Garcia Official on all social platforms. And you can reach out to Anna at
I'm @Annabilic_realtor on Instagram and Annabilic everywhere else.
Awesome. Thanks so much, Sierra.
Thank you.